Hello and welcome to Bloomberg Quint. JK Papers has come out with a mixed set of numbers, and joining us to discuss the results we are having the company's CFO, Mr. V.K. Kumaraswamy. Hello sir. Sir, could you tell us the reasons why there was a degrowth of almost 10% in the revenues in this quarter for the company, if we take it on a consolidated YOY basis?
The company declared its best ever EBITDA, PAT and PBT margins, and of course there was a lot of savings in cost as well as reduction in input prices and that we have gained by. But however, there was some amount of setbacks in terms of sales quantities, especially in coated and in outsourcing areas, and a lot less impact from copier and packaging board. Sales were a little sluggish, and as a result there was some drop in the quantities. But of course the prices which had prices were substantially better than the same period last year, and of course compared to the previous quarter there has been some amount of softening by about percentage point or so. Overall, I think the quantity impact has been there, and we did see a little bit of sluggishness in the market. But however, in the last 2 or 3 weeks, we are finding that the quantities have started moving once again.
Can you tell me how the pricing has been, for the last months coming in, and what you can expect going, for the next couple of quarters?
Prices, I think, are a function of how well the quantities are moving and whether the market is oversupplied or undersupplied. So once the sales start being sluggish, prices do tend to move in sympathy. So as of now, we are seeing that for this current quarter, the impact from prices will be marginal, as we are finding that the stocks are getting moving faster. So we do expect that this quarter the prices will stabilize at the current levels, and which are about 7 to 8% over last year's levels.
So could you please tell us about the input cost, the lumber prices as well as the pulp prices, what trends we can see, and any impact on the margins we can see going ahead?
Yeah, as you see, there's been a significant impact in the margins, 7% over previous quarter, and if you compare to the same period last year, it's in double digits. The areas where we have been able to get significant cost reductions are: one is the pulp prices. As you know, internationally the pulp prices, which were ruling at even about $800 or something, have dropped to about 550 levels now. And domestic raw material prices also, we have been shrinking the area of catchment area for wood. As you know, we are a wood positive and carbon positive company, and since there is a reduction in distance, the logistics costs keeps coming down, and we were able to get about 4 to 5% cost savings there as well. There have been some savings in the chemical rates, and last year also we had to take 1 or 2 big provisions in terms of RPO, that is renewable energy purchase obligations, as well as some sales promotion expenses, as well as the company has more or less fulfilled all its obligation under EPCG licenses. So the exports also have significantly shrunk. Export related expenses also have come down. All this have added significantly to the cost reduction and cost optimization, and that's why you see a very significant expansion in margin during the current quarter over same period last year, as well as even the previous quarter. There is almost a 5 to 6% jump in the EBITDA margins as such during this quarter.
So if you can say that, what are the current capacity levels, and also the utilizations level, and will we see any kind of expansion?
The utilizations levels, capacity utilizations are about 116%. Our nameplate capacity is about 455, but with that we are able to churn out almost 490 to 500 kind of quantitative levels. And as you know, we have taken over Sirpur. This is without Sirpur. As you know, Sirpur has been taken over last August, and refurbishing activities were going on, and part of the capacities which have become operational, we have capitalized from May 24th, and the balance, which should account for balance 3/4 of the capacity, will be operationalized during the rest of the year, maybe September, October or thereabouts, as well as the main bleaching and this one CLO2 plant, etc. commences. Then we will be able to match the quality as well compared to the competitors' quality, and we should see significant movements in the market. So that should put up the nameplate capacity to almost 590,000 tons. And as you may be aware that we have announced a major capacity expansion in our CPM, that is Songad plant, which is in the western this one. And this is for packaging board integrated with own pulp, and that should add another about 1.7 lakh tons, but that's earliest expected by end of 2020 calendar. So this is the quantity expansion plans that we have.
Sir, the last question is, what is your current debt levels, and is it at a comfortable level, as compared with equity?
The net debt levels will be hardly about 500. As a percentage of debt by equity, it's just 0.4 times. And even if you take it as times EBITDA, the net debt is hardly about 0.7, 0.8 levels. And we will further run them down during the year from the year's generations before the debt for the new project will start kicking in. Even at the peak, I don't think we will run beyond 1:1 kind of debt equity. In fact, it should be around 0.8 or something. And as a percentage of, in comparison to EBITDA, maybe about 1.2, 1.3 maximum. These are very comfortable levels, and we will be able to weather any, unforeseen contingencies as well with that kind of debt EBITDA levels, as well as debt to equity levels.
So if you can give us a ballpark figure for the debt, for FY20, what would it be around?
Well, the current net debt levels is about 500. The gross should be around 1250 to 1300 crores.
Okay.
And if we make full use of all this cash flow, presuming, we should be able to run it down by another 350 to 400 crores during the year.
All right, sir, we'll leave it till there. Thanks for talking to Bloomberg Quint.
Thank you. Thanks so much.